All right, why don't we take this in two parts? Let's start off with the recession concerns from Jeff Gundlach. Jeff Gundlach, a very notable and respected market voice. Do you agree with him that we may be headed towards a recession here in the U.S.? And if so, specifically talking about U.S. equities, what would you suggest that investors do?
So first of all, I think it really depends on how the tariff plays out. I think the longer the tariffs are going to be in place and if more tariffs are going to be implemented, I think that definitely raises the chance of a recession. However, if we still don't have any clarity on that, and judging from the recent hot economic data, I think things are still fine. I mean, particularly the labor market is still on pretty solid foundation, and you can't see from the Fed's forecast that they're expecting anything really bad. I mean, a slowdown, but not anything recessionary. And I think it takes a lot to get a recession. I think energy prices are going down, and that typically is a big factor of driving recession in the U.S. And if we don't see shocks like energy prices, then I think it will take a lot to push the U.S. into recession. But at the end of the day, I think there's a lot of uncertainty on that. And so we have to be prepared.
Okay.
And I think in that scenario, if the worst case economic situation develops, then I think government bond should act as a pretty good hedge. We have seen how U.S. Treasury yields, the longer term ones, have come down because of recession concerns.
Got it.
I think it will likely continue to work in that environment. And of course, gold will still be a good bet against
kind of a
recession.
hedge. We've seen gold actually hit all-time highs very recently, pulling back just a bit this morning, but obviously a safety play. Also a lot of central bank buying, fueling that upside move. All right, let's go to the other part of Jeff Gundlach's argument. He says investors, they should shift away from U.S. equities and look for opportunities in overseas markets. I want to ask you, are you seeing a lot of opportunities in overseas markets, and are you worried about, I guess, risk of contagion? If we see a recession or a major slowdown in the U.S., wouldn't that more than likely hit those other overseas markets as well?
Yes, absolutely. That's why I don't actually think the market is pricing in or definitely very concerned about a U.S. recession, because at the end of the day, if the U.S. were to go into a recession, then I think the other regions are very likely to suffer as well. So what we see is that ex-U.S. equities, they're actually doing quite well, especially in Germany and places like Hong Kong indexes, and countries that are typically affected by tariff, they're actually doing okay. But I think for investors, right, like us, we have turned more optimistic on the longer term growth outlook for Europe because of the rearmament outlook of Germany shifting their mindset from conservative being to very aggressive in boosting the fiscal stimulus. So I think that is really a big shift in mindset. And for investors, I think this is something to watch in the future. And for us, we closed out underweight in Europe ex-UK equities, primarily of this fiscal boost from Germany. So I think for the U.S. equities, we trimmed our overweight, but that's really because of the fact that we have been overweight for quite a while, and it's good to take some exposure out and diversify amongst other regions, given that there's so much uncertainty with U.S. policy that we may see a policy mistake at some point.